welcome back to this month's Startups Streamlined with Thompson Hine. I'm your host, Lindsay Stencel. I am a partner in our New Ventures practice group. And today, joining me, I have Suzanne McNabb, Senior Counsel in our Corporate Transactions and Securities practice group, or as I like to say, the Queen of Venture Debt and all things there too.
In the Queen City.
And so Suzanne focuses her practice on general corporate counseling, commercial finance transactions, mergers, acquisitions, corporate governance, and of course, venture debt, the topic that we're here to talk about today. So startups that are exploring financing options may look to assuming venture debt to raise some capital. As opposed to conventional business loans, this type of debt offers more flexibility and is less dependent on certain factors, including accounts receivable, inventory, cash levels. So natural fit for our venture clients, right? But today we're going to explore the startup growth model and learn why businesses are tapping into venture debt more and more where appropriate to strengthen their relationship with venture capital investors and better use their capital stack. So if you have questions or comments, as always, please drop those into the Q&A section so that we can answer those. And we try to do our best to keep an eye on it. If we don't get to your question, we will follow up with you afterwards. So don't fret, we will get your questions answered. So we'll try to do our best to get to everything. So with that, let us get started. Suzanne, thank you so much for joining us today.
You're welcome, Lindsay.
Yeah, looks like a nice day there in Cincinnati, Ohio.
Sun is shining, but it's actually a little cold. I'm not ready for winter.
Same. So let us just jump right into it because I've seen the list of folks who are out there in the ether today listening to, hey, what is venture debt and how can it be helpful? So if you could just start us all out on a baseline level and tell us, what is venture debt?
So venture debt is debt provided primarily to venture-backed companies by either specialized banks or kind of non-bank lenders. Sometimes you see debt funds that do this type of lending. And it's predominantly to, I would say, kind of post-Series A, more-ish stage companies, because the lenders look more to who are your investors, who are your LPs, or so who are your investors, and the size of your business and your growth trajectory than your actual balance sheet and cash and accounts receivable and traditional lending parameters.
Right. So a little different than your traditional bank loan, but maybe it sounds like also different than what I think a lot of people are very familiar with, which would be a convertible debt instrument. So let's level set there, because I think some people come to me and they say, hey, I want to take on venture debt, and they're a pre-seed stage company and we're not there yet. So tell us about that, how venture debt are different.
Yeah, you really hit the nail on the head. I think we see convertible notes used more by, very early stage companies, because those notes, while they're a debt instrument, the investor primarily looks to sort of the option to convert to equity as what the instrument truly is. And with venture debt, it really is like a traditional bank loan. It has reps and warranties and covenants and those types of things, and they expect to be repaid at the end of a term. Whereas with, again, sort of a convertible note, the expectation is it's going to convert into equity at your next round or a liquidity event, et cetera. So while they're both notes, they're used differently in the life stage of a startup.
Very true. So I want to come back in a minute to the reps and warranties and covenants. But before we get there, can we kind of talk a little bit more maybe about when it might be appropriate for a business to start thinking about how and when to take on venture debt? Because I see a lot of companies that either don't know that they're a good fit for it, or that they don't even think to ask about it. It would probably be a better funding source than maybe taking on some more equity capital. So could you talk to us about that a little bit?
Sure.
Good.
Sure. I think the age-old adage is that banks only lend to people who don't need it, traditional banks. I think venture debt is not too dissimilar. The best time to reach out to them is when you're doing a fundraise, right? So start making those calls at the same time as you have an equity term sheet, because that's when you're in the strongest leverage, you have the strongest leverage, you're in the best position to negotiate. And they really look at the strength of your kind of investors to make sure that you will have follow-on rounds of capital, or you're going to be able to attract new investors, or you're going to grow to the next stage of a startup. And so when you have that sort of term sheet in hand, is sort of the best time to start those conversations with your venture debt lender as well. I think, all in all, for all companies, debt is cheaper than equity. And so, if you can plug a hole with some debt, that's going to be cheaper for you than having to give up, another 4% of your company because you need to raise $2 more million of equity. If you can get, a sliver of venture debt in there alongside an equity raise, you're in a better position long run.
Exactly. So why are venture debt providers so curious about who the venture investors are in the equity side of the transaction?
I think that primarily goes back to kind of why seed stage companies aren't great candidates for venture debt. It's because they want to know that you have sort of a pipeline and next steps laid out. They want to know that if you need more capital, that your investor partners are going to be able to fund the business longer because you don't have the balance sheet, or the traditional collateral that a traditional lender would look to. So they're really wanting to make sure that your investors or your VC funds or whomever will, fund you again so that you can they can get their loan repaid.
Right.
Simple
right. Yeah, super, super interesting. So let's start to get into the nitty gritty of traditional terms for venture debt. So first, let's talk about on its baseline, what are reps and warranties and what are covenants in venture debt?
So, if you've ever had any sort of loan, you will see that they require a business to make reps and warranties about their business, that they're paying their taxes, there isn't litigation, just, where they're formed, just general sort of statements of fact that they rely on in making that loan to you. And so those will all be in a venture debt loan agreement, just like they'd be in a traditional bank's loan agreement. There'll also be what's called affirmative and negative covenants. And the affirmative will be things like, again, you'll continue to pay your taxes, you won't change your business, you won't amend your operating, or that's probably negative, but, all about operations, affirmative statements about your operations, that you will provide financial statements to them that you negotiate at certain periods of time, those types of things. Then the negative covenants are things that you promise you won't do. And those entail, selling the business without their consent. Probably the ones people get tripped up the most on are making distributions. They normally have a prohibition on distributions to the members. I mean, most early stage companies aren't in that position where they're distributing cash, but sometimes it surprises people. I would say another one that sort of can trip people up is no, you can't get any other debt. There'll be limitations on additional debt that you can incur. And again, most of the time, if you have a good partner in your venture lender and you need to do any of those things, you can go back and get their consent, but you obviously can trip a covenant and, get into trouble by doing those things without talking to your bank. And I think most small businesses, when they aren't used to having those types of arrangements in place, it's not that they intend to not follow them, they just don't think about them because they're not used to having to kind of answer to somebody else or get someone else's consent. So
right.
True,
very true. And so What's the average size of a venture debt instrument? Question one. Question two is, can you talk to us about what the repayment on a venture debt instrument is going to look like? Because it is, like we talked about at the outset, right? It is debt. It needs to be repaid according to a schedule. And so folks also need to think about that, because it's not like the convertible debt where you just let it ride.
Right.
So let's talk about average amount of loan size and then duration,
Sure.
time of payment.
Sure. So I would say the key terms are sort of the length of the note. I mean, again, most of these vary, and I would say they vary based on sort of the size of the company. Earlier stage companies that are able to get venture debt versus more growth stage, later stage, that, you know, they may have more structure in sort of a later stage. They might actually add financial covenants, which we didn't talk about. Those aren't very normal in earlier stage venture-backed companies, but later stage you might get, you know, more structure into the facility itself. But the length, I would say, you know, can be 3 to 5 years. I mean, the use, we didn't really talk about that. The use can be anything, just as like performance insurance, just in case something unexpected happens. It could also be for equipment. It could also be for an acquisition. It could be to grow your sales team. So there's a lot of flexibility in the use of it. And sometimes that use will dictate the term, right? So it could be, you know, 3 to 5 years, I think, is probably relatively normal for the payback. The size, you know, again, they often peg them to the size of the round that just closed. So, you know, I think 25 to 35% of the most recent round is probably a good rule of thumb. Often another term is you know, we talked about when you want to raise some money, and we said it's when you have money. The best time to raise money is when you have money. That's helpful, right? A lot of the notes have draw features so that you don't have to, you know, draw it all at one time. You kind of have the dry powder, but you don't have to draw all the capital at one time. So, and often during that draw period, which could be a year, 18 months, something like that, it'll be interest only, which is nice. And so you don't get to the principal repayment then until after that period. And then, like I said, you'd have a principal repayment over the period of time until it termed out. You know, interest rate obviously is another variable. It's hard for me to speculate on what those are now in our interest rate environment, but you know, this is more expensive than traditional debt, but probably less expensive than maybe mezz type debt. You know, I would say 7 to 12% has been sort of historically true. Again, interest rate's going to depend on your business. And yep.
Very interesting. So, a couple questions are coming into the chat here. So the first one is, in your experience, how many times has venture debt been canceled in subsequent years? Meaning, like, sometimes we can see an extension or a renewal period if it hasn't been repaid, or we need to restructure the vehicle. Have you ever experienced where the lender canceled?
I have not. I mean, I've done a number of extensions. We've repaid some, but I have never had a lender come back and say, I don't want to do business with any of our clients anymore. I'm guessing it happens, but probably, you know, less frequently than you think.
Yeah, and I would say, I mean, from my experience, I think the things that I've seen people, lenders get a little bit more persnickety about, if you will, is like a line of credit, for example. Say if the line hasn't been rested. So if you have a line of credit, sometimes they say, hey, you have to repay the line and then you can redraw the line. But if you don't satisfy that covenant, repay the line, then they will cancel the line and call the I would see that.
Yeah, or they'll make you term out the line and do something else, right? You're not using it as a line, that type of thing.
Yeah. Right. So I haven't actually seen it in venture debt. So great question. And I usually see the lenders themselves being very, you know, they're savvy folks, but they're also flexible. Right? So they're not gonna, you know, try to get blood from a turnip if it's not there. If they need to give you the extension, they're gonna go ahead and do that. So Great
Right, and
question.
they have skin in the game with their warrant, which we didn't talk about.
Wow, let's talk about that for a second.
Right, talk about the warrants.
Yeah.
So, that's the difference between venture debt and obviously traditional debt is they take a warrant, which is like an option. Most of them don't plan on ever exercising that warrant until there's, some sort of liquidity event. But it does, in, these circumstances, it gives them some upside and, they try to preserve that as long as they can. So I do think in probably some of these relationships, it plays a role in their decision-making for sure.
Yeah, and I do think that's important to note here for those listening, whether you're thinking about lending or you're the recipient of those funds. A lot of people say, well, I want to take on venture debt because I don't want to take dilution. You will take less dilution, substantially less dilution, taking the venture debt because you're going to repay that. But there is going to be warrant coverage, what we call warrant coverage on that, meaning there is going to be a small percentage of warrants that will be issued to the debt holder, meaning the lender, that they can participate in the future on some of the upside. And the thought being, right, but for their line or loan, you wouldn't be able to get to the next level of your business. So it is fair, but I think people need to hear that because sometimes people are. I was representing an investor, but the company that they're talking to, the guy kept saying, well, I'm going to take on venture debt and I'm going to take no dilution. And I finally just had to stop him and I was like, but you will still take dilution.
Yeah. There's a piece. Yep, there's a piece for sure.
Yes, for sure. So, okay, next question. Does venture debt require personal guarantees from the startup company founders or maybe even some of the investors?
That, I think, is a major upside of venture debt. Most, as you all probably know, most traditional banks will always take a guarantee. It's very hard to talk them out of requiring a guarantee. And most venture debt, no guarantee. So that's a major bonus for founders, I think, is, you've already invested enough. You already have enough stuff on the line. At least you don't have to sign a personal guarantee. So
yeah. Definitely. And look, that's different than securing it against the assets of the business, right? So there's still a lot to be the top of the pile. So if things go sideways, that debt holder is the creme de la creme of debt holders in that.
Right. We didn't talk about that, right? Venture debt is secured by all the assets of the business, and some take a security interest in intellectual property, some give a negative covenant on intellectual property, but in all events, they're fully secured for their loan, and that's their additional protection.
Right. So if that means if you have debt on your books right now, convertible debt, for example, those debt holders are going to need to subordinate to your your venture debt instrument. So just something to think about as you're layering these pieces together. So coming back to the warrants, what is the range of percentage of warrants and what is the average term on those warrants?
I would say the range, and again, these are all ranges, I would say sort of 5 to 20 is probably what I see. 20 is obviously high. 5 to 8 is probably, 5 to 10 is probably more normal. 20 is probably the outlier. And, the terms, I feel like they're usually 10 years, although I haven't really thought about that in a while. Yeah.
Yeah, I usually see a 10-year term on the warrants. Have I seen warrants that are as little as 1%, warrants in total, meaning 1% of the company on a fully diluted basis? Yes. Have I seen them as high as 8%? But that was a huge instrument. Also, yes.
Yeah.
So. Yeah.
And I think the other, question that goes along with the warrants is, if you have multiple classes of equity, preferred or common, what would they take? I see some that say, I'll take the senior most of anything you have. But I do think that's a point where you can sometimes push because they often don't really care about the bells and whistles that go along with preferred, particularly if it's mostly tied to voting, because their goal is really not to exercise them until liquidity. But, you don't always have, sometimes you take what they'll give often, but might be some room to push back there. And I think that was another, thought I had on this when you're talking about, when you get these term sheets, for a term sheet for venture debt. It's not a bad idea to run it past your attorney, just because we have seen, often we'll have multiple term sheets that we've worked on recently, and we can say, hey, the ones I've seen recently are, giving common, or they're actually only 4% at warrants, or whatever. And, again, it's a negotiation between you and your lender, but sometimes having a little bit of market knowledge can help. But most of the time, otherwise, people will come to us after they've signed the term sheet, which is fine too. But we can sometimes provide a little bit of help at that term sheet stage.
Yeah, I mean, and not just because we're wearing the hats that we wear every day as lawyers, but I mean, I would tell you, call someone. Whether it's for someone else, call someone before you sign that, because sometimes you don't know, especially when we're talking about these covenants. So sometimes you have funky debt covenants that sit in these instruments that prohibit you from having what we call debt ratios that exceed a certain threshold. So you really do have to be careful there, because if you don't know what you're getting into, and then once you sign it, it's a little hard to backtrack from that. So
yeah.
What would you say is really the biggest pro of venture debt?
I really think it's the smaller slice. It's in lieu of having to do an additional capital raise, right? So if you're really just, you're doing a $20 million raise, and you really wanted 22 or something like that, right? You can get that extra $2 million in venture debt. That's less equity you have to give up. And I think it's flexible. It's structured. You kind of know what to get, what the terms are. And I think it looks, it just gives you kind of a bit of an insurance policy, particularly if you're not really sure how you're going to need it or where you're going to need it. But, we live in uncertain times. So having a little bit of extra powder is always a good thing. What about you, Lindsay? What's the pro that you think?
I think it's not taking the extra added dilution of putting that $2, $5, $10 million onto your most recent preferred raise. And I say that for two reasons. One, it becomes punitive to the founders and folks who've been around for a very long time. And, they're just watching their junk get chipped away at pretty substantially. But sometimes that extra, let's call it 10%, can really skew voting thresholds of their preferred stock.
That's true.
Do it. And when we do that, especially if you're a founder who's very big on maintaining the strategic vision of your business, and you really, continuing to have a strong voice on the board, I think that becomes exponentially harder the greater, you get behind, preferred percentages who have big, strong voting rights. So I think that's probably my number one if I was going to pick one. So let's talk about flip a bit. What's the biggest con to venture debt?
Well, I think con is probably one, availability, right? And again, what I said before, you kind of can get it when you don't need it. That's always can be hard for people to understand, right? I'll just get venture debt. Well, if you don't have, venture investors that are alongside, it's not in lieu of venture equity. It's alongside of that. So I think that can be I think that's probably not as much of a con as much of a misnomer. I think people don't really understand that. And I think obviously understanding the covenants and what goes into them and what that means for your operations on a go-forward basis. Again, most businesses live with those, so it's not unusual. It's just getting your mind around them and making sure that you're, aware of them and compliant with them. And that can be something that folks just aren't used to doing.
Yeah, I would say from my perspective, I think that the biggest con is managing those responsibilities or those covenants. Because if when you're a startup founder, particularly, you've got to be creative, you've got to be scrappy, you've got to be able to move really, really quickly. And when you have venture debt, I know a lot of founders gripe when we're like, hey, well, I love that you want to do that thing, but we got to send it out for stockholder approval, right? And now, not only do we have to send it out for probably stockholder approval, but we probably also have to send it out to debt holder approval. And usually those folks react fairly quickly to things, but not always. I mean, some of them are very big shops with very deep, departments that they've got to send things through. And so, not to say that it quashes or quells creativity or, vision, but I think, you have to be aware that you have different guardrails or bumper rails in place that you didn't maybe have before.
Yeah.
And so I see some folks struggle with that, especially folks who are, changing directions, pretty rapidly. And, we have to slow them down and be like, you cannot do that. Because no one likes to hear that. And I guess if I was if I was wearing my investor hat, I think on that side, because I saw some folks out there, their investor side representation, just trying to manage the expectations of the startup and through the process. I think it's probably one of the biggest cons because they just don't always fully grasp, no matter how many times it's been gone through, the reps and warranties that they have to hold to, the compliance related to the instrument, and making sure they're adhering to the affirmative and negative covenants. So it's a little bit of both sides of the equation.
Yeah, and for investors, it's a juggling act too, right? Making sure the debt stack size is reasonable to the business, which most lenders are pretty good at doing. But I think most investors like it because it's other people's money, right? That's always a good thing. But at the same time, right, you have to just make sure that you've got the right mix of equity and debt. And
100%. Yeah. So look, if you're interested in taking it on, or you're thinking you're the person who either wants to do this type of instrument as an investment, or you are seeking this as a recipient of said investment, don't hesitate to, first of all, reach out to folks who provide these types of instruments. They don't know that you're out there hunting for capital unless you tell them sometimes, right? And then don't go at it alone, I think is the biggest thing. Don't try to tackle some of these instruments. Suzanne, how long have you seen them be? I mean, they're not, a one-page sign.
Oh no, yeah.
Their type of an instrument. These are dense
documents. Yeah, they're 20 pages easy.
Right.
Lindsay, I guess maybe not that we're affiliated with any of these lenders, but who do you see as the most active in your practice? And
so it kind of depends on the space. I've done a ton of work with the SVBs of the world, Signature Bank, Grasshopper Bank. Let's see who else. There's NCAP. I see them do a lot of it.
NCAP, yeah.
Now, there's quite a few SBICs out there who that's just part of their strategy. So take a list at the government available list on the SBA website, defining who the SBICs are. And it's a quick and dirty way to figure out where you can probably pull some capital from.
Yep.
Great question. So with that, we will begin to wrap up here today. So if you have any other questions, feel free to shoot us an email and we will work to get answers back to you expeditiously. But that's going to go ahead and conclude today's discussion. This webinar was in fact recorded. You had to click the OK button in order to participate here, but it will also be available in our library of recordings on our Thompson Hine YouTube channel. So as always, like, subscribe, and ring that bell so you can get updates on our YouTube channel. So we want to thank all of you for attending today. And most importantly, I want to thank the Queen of Venture Debt, Suzanne, for joining us. So this is super helpful and informative for all of us.
Thanks for asking me to be on, Lindsay.
Yeah, it's wonderful. I'm super excited.
Always good to see you.
Yeah, thanks. When the webinar ends, folks out there in the ether, if you wouldn't mind responding to the brief couple of questions that you're prompted to respond to so that we can react to the best topics for you in the future, because we're planning next year's schedule already.